Hi, this is Kerry Artak with Artak Advisory, and this is the AgriTalk video supplement for Monday's show, September 20th. Before I jump into the charts, I really want to urge you to fill out that free trial form. Take advantage of my 2-week free trial offer. My time on AgriTalk is not a paid spot. I really do it, first of all, because I love it. I do love sharing this information, but really, I'm trying to generate new business. And if you could take my work for a 2-week test drive, check it out for yourself. You just might want to keep it as part of your regular repertoire of analytical tools. I work with small, mid, and large scale grain growing operations and cattle ranching operations, and I help them with proper hedging, the timing of hedges, whether to hedge or not hedge. I do articulate much of that in the newsletters itself and in all the audio portions for my newsletters. By the way, the newsletters have an audio portion attached to them that's several minutes long every single day. So, you get some description not only from the reading the newsletters, but also you hear my voice and just sort of like a kind of a straight talk, what's going on in the market. Anyway, enough of that. If you're at the website right now, click on that free trial form, first name, last name, email address, and a phone number. You'll get the newsletters right away, uninterrupted, for 2 weeks. Everything that I produce on a daily basis. You'll get a call or two from me, a call certainly during the free trial to answer any questions you might have, talk about your trading needs, talk about if you hedge or not, if you trade or hedge, and what your style is, so forth and so on. And then, of course, I will follow up at the end of 2 weeks to see if you may have an interest in becoming a regular monthly subscriber. There are no long-term commitments. Many people just go month by month. Cancellation allowed at any time. So let's jump into the charts. I cover 3 markets in Monday's show. December corn. What else? December live cattle. And November heating oil. And so let's jump into corn right now. You're looking at a long-term weekly chart of the broader Chicago Board of Trade corn futures market. It is now reflecting the DEES 21 contract. This is the stringing together of previous lead contracts. I can go back on this chart and circle an area where we had a long-term buy signal last December by closing above that channel formation that was 4 or 5 years in the making, a horizontal structure that did set off follow-through buying as expected. At one point, I was expecting that 834 and a quarter channel top, and that was earlier in the summer, May, June, I was talking that way. There was a speed line that was rising that needed to support the market. And as long as we were above it, which is now at 700.25, as long as we were above it, I was still anticipating 834 and a quarter as a 3 to 5 month target. But we did settle below that. We rolled below it, actually, when we rolled from July to the September contract. And in the process, set off a meaningful sell signal through the rest of the year. And that's what we've been in the midst of ever since. I have been anticipating 464.5. We haven't reached it yet. There's been a lot of consolidative trade this summer. But I still think 464.5 is in reach below the 580s, 587 and 3/4 to be exact. And that is this chart here. It's the same exact chart I showed you in the previous slide. This one just opens up. You can kind of zoom in on just the last 2 or 3 years. And you can see there's a simple channel structure presently at 587 and 3/4. I don't know if we're going to test that in the coming weeks, but if we do, it can contain buying on a monthly basis, quite possibly through the balance of the year. And below that, this market remains inclined, I think by the end of the year or sooner, to actually test that 464.5 long-term support level where the corn futures market can bottom out through 2022. Now, upside, when or how will we wind up testing the upper 580s? That's obviously not known, but my signal, and this is the December chart itself. In other words, this is the DEES 21 weekly chart. It's just DEES 21. And it has a descending 1/3 speed line that was in my newsletters last week as an area that can contain weekly buying pressures. It remains at 533 and 3/4 this week, dropping every week. We tested it last week, came back just a bit, holding below 533 and 3/4. I do think that over the next, 3 to 5 weeks or so, say by the end of October, we can actually fall back to that 464.5 long-term support level. But if we close this week above 533 and 3/4, then we have a 2 to 3 week buy signal essentially into the upper 580s, mid to upper 580s. 585 and 3/4 would be the target on the December chart. But if you go back to this chart, the more meaningful horizontal channel structure on the weekly continuation chart, which is a different set of data. It includes the data from DEES, but it also has previous contracts, like September and July and May, so forth. It's at 587 and 3/4. So, closing above 533 and 3/4 would indicate that 587 and 3/4 channel top, where we can top up through the balance of the year. Once tested, the market can fall back to 464.5 within 3 to 5 months. But if we close above 587 and 3/4 at the end of any week, then we have a good annual low. The market then expected to continue an upward recovery over the following 2 to 3 months at the soonest, could take as long as 3 to 5 months. That would put us into late winter or spring, whereby we should then continue onward and upward into the low $7 area. That 700.25 to 714 region, able to contain buying through next spring. And once we test that area, the market can fall back over the months to follow. I think that pretty much covers it for corn. Let's move on to live cattle. We just rolled to December's high volume contract. This is a weekly continuation chart that is a volume-based rollover. In effect, it is always reflecting the high volume contract, which is presently December, having rolled out of October last week. And so December is at 127.52, and it inherited this long-term weekly chart, which I use as my primary means of determining long-term trend status. And what I see here, and have been talking about for months now, is a long-term resistance level at 134.50, a descending channel top that's 5-6 years in the making. We rallied to within about 2% of it about 4 weeks ago. October was then front and center, and we came falling back, obviously. 134.50 is not far off. We may actually test it in the weeks ahead. I'll get to that in a moment. I don't have an indication of testing that. But if we do, it can contain buying through 2022. And from there, the market can fall back. Right now, meaningful near to longer term support is at 116.20 to 117.12. And in fact, I think that this market is still susceptible to testing that lower area by the end of October, so long as the December contract continues trading below, and this is a December only chart. This is a December weekly chart with December only data. As long as December continues trading below this channel structure at 131.12, I think that by the end of October, it can continue south down to 116.20 to 117.12. Once again, 116.20 to 117.12, meaningful support, able to absorb selling through the rest of the year. Once tested, the market can turn back up into the low to mid 130s again within several months. But if we were to close below 116.20 at the end of any week, and I know it's a long shot right now, but for those of you who are interested in the big picture, the longer term outlook, closing below that structure, which is rising weekly, by the way. And so what's 116.20 this week will be higher as we move into October and November. But closing below those structures, that combination 1/3 speed line and channel bottom, would signal a good high through the balance of the year. The following 3 to 5 months or so, which would put us into later winter, expected to continue south, the market likely to collapse in price down into the mid to upper 90s. So if we close below 116.20, that 94 even to 96.50 region, combination channel bottom rising 2/3 speed line, is then considered, I think, a realistic 3 to 5 month target, whereby the broader live cattle futures markets can bottom out through spring and into summer of next year. But it's not an objective yet. The mid-90s are not considered a target until we close below 116.20. I've been telling subscribers now for months that there is a scenario we could trade inside that 134.50 ceiling to 116.20 floor through the rest of the year. If we were to close above 134.50 at the end of any week, then we have a long-term buy signal. And I think the market then is likely by this point next year or sooner to test that 2014 high at 117.75. And finally, heating oil. This is a weekly continuation chart of heating oil, presently reflecting the November 21 contract. I've had this 2.3239 channel top now as a target for some months, going back to February, so 6-7 months or so. It's been an objective. We've had a lot of consolidative trade in that time frame, but it is still in reach. The market pushed to a new high last week, did not settle above the May high, I believe it was, but came very close to it. 2.3239 is in reach over the next few weeks, and it can absorb buying through the rest of the year, possibly through next spring. From there, the market can fall back in a meaningful way for many months to follow. But if we did close above 2.3239 at the end of any week, then we actually have a longer-term sign of bullish continuation. The following, I'm going to say 3 to 5 months, could take the better part of 6 or 8 months up to 2.9084. So if we close this week above 2.3239, we should into spring of next year reach that 2.9084 formation, which is significant in its ability to contain buying through next year. And from there, the market can fall off for many months to follow. And then finally, if we were to close above 2.9084, then 3.61 becomes the next, 5 to 8 month target, so forth and so on. It's very stair-step. There's no way for me to say, or anyone to say, that if we closed above that 2.3239 formation that we're destined for 3.61. That may happen, but you need to honor that 2.9084 ceiling as one able to contain longer-term buying pressures. Now, downside, as long as this market continues testing and holding below 2.3239, it can fall back to meaningful support presently at 1.9272. That 1.9272 presently a convergence of two channel formations, but it is that longer rising one off the April 20 lows that is the more meaningful, and that is at 1.9272. It can absorb selling, say if tested by the end of October, could contain selling through the balance of the year, and from there the market can turn back up to 2.3239 within several months, but closing below 1.9272, good high not only through the balance of the year, but probably into next spring. I would expect roughly 1.25 over the following 3 to 5 months. And that is all I've got for this week's AgriTalk video supplement for the week of Monday, September 20th. And don't forget to fill out that free trial form. I'll talk to you soon. So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You have nothing to lose and much to gain.